Good morning, everyone, and thank you for joining us this morning. Today's presentation by CBM and MBI, the firm's financial advisory subsidiary, is entitled Grow Your Net Worth, Top Strategies and Opportunities for Early Career Stage Professionals. And our presenters today are Reema Patel and Abbie Niehoff. Reema is a manager at CBM who has nearly 10 years of public accounting experience. She provides financial planning and tax services to individuals, small businesses, and nonprofit organizations. As part of her leadership role at CBM, Reema is developing a business plan to deliver financial planning services to Generation X and Y professionals, thereby contributing to a new client model for the future of the firm. She also graduated from the Greater Washington Society of CPA's Margaret DeBow Leadership Development Program, which provides professionals with management development, communications, and leadership expertise. Abbie is a financial specialist at CBM with nearly 5 years of financial planning experience. She delivers financial planning expertise to divorcing clients to set up a financial structure that will help them be set up for financial success in this next step of their lives. She also serves as a financial planning associate with MBI, the financial advisory subsidiary of the firm. Abbie earned her Certified Financial Planner designation in 2021. I'd like to thank everyone once again for joining us. For those of you who submitted questions during the registration process, those have been submitted to our presenters and will be addressed over the next hour or so. If you end up with questions during the presentation, please feel free to use the chat box, and Reema and Abbie will address them either during or towards the tail end of the presentation. This session is being recorded, and all attendees will receive a copy of the presentation slides. If you are participating using your phone, please make sure that you email Joe Kovacs or Marissa, who would have sent you the RSVP reminder, so we can make sure we get the slides to you. And with that, welcome once more, and I'm going to turn this over to Reema and Abbie.
Hi, everyone. Thank you so much for being here today.
Thank you for joining us. This will be a very exciting presentation.
All right, so these are the topics we're going to go over in the next hour. We're going to start off with some basics, what your net worth is, what that means, and then we'll go over some goal setting techniques and budgeting. We'll talk about saving and investment, how to manage your debt and liabilities, and then we'll touch upon insurance, estate, tax planning. And we'll wrap it all up nicely with a little overview of career choices.
Yes.
So to start off, Abbie.
Yes. So what is your net worth? That's a big question, very basic in financial planning. So really what net worth is, it's your assets minus your liabilities, and your assets are going to include things like your bank account, your investment accounts, your retirement accounts, your house sometimes, your car sometimes. Hopefully those are included in assets. And really any other personal property you have, such as jewelry, designer handbags, so on and so on. Liabilities are the things like your loans, your mortgage, car loans, student loans, any credit card debt you have, and any other just general debts that you have. And really your net worth, it's a fluid number. It's going to change from day to day and even minute to minute, depending on the stock market, depending on if you have to go fill up your car at the gas station, that'll decrease your bank account or increase your credit card balance. So it changes, and it's just that one pinpoint in time of what your net worth is. And overall, the main goal is to increase your net worth by changing one of these two variables, so either increasing your assets or decreasing your liabilities. So we wanted to make this a little interactive. So if you guys can enter into the chat box what you think the average and then the median net worth of someone under 35 is. Oh, anyone wants to type that, and I will give that a couple. Oh, $1 to 35, or some people, yes. Jordan, 1.5 million. That would be nice. 15K. That's pretty close. So 10K. Again, yes. So we will go on. So the median net worth for someone under 35 is, again, it's a little under 14,000, and the average is about 76,000. I don't like to look at the average particularly for these things, and I think median is a better picture of just the typical real net worth of someone under 35. The average is skewed by those high outliers. So I like to give the example, Kylie Jenner's net worth would be included in that 76,000. And I don't know many, 23, 24-year-olds who have $1 billion. So that's just highly skewed by people like that. The typical person under 35 isn't going to have anywhere near that probably in their lifetime. I mean, that would be nice if we all could, but that is unrealistic. So what do you guys think the average and, again, medium net worth is for someone between 35 and 44? Again, type this into the chat box. $30K, $500K. This one, $50K. Okay. So this one, the median is going up towards 91,300, and the average, again, this average you see is highly skewed by the extreme wealth. But as you get older, your salary will increase. As you grow in your career, you'll be able to start investing money, and your net worth will go up a lot quicker as you, again, get some of your student loans paid down, your credit cards paid down, and whatnot. So going on to the next slide. Oh, actually, before we proceed, I wanted to highlight just really the general rule of thumb when it comes to increasing your net worth and just kind of getting on track to do this. So by the time you're 30, you should try to start saving or have half of your annual salary saved by 30. And then by 35, try to save 1 times or have a net worth of savings of 1 times what your salary is. And by 40, 2 times of your salary. And it's going to be easier as you get older and as you progress in your career to save more and more, because when you start, the salary is not that high and you're not going to be able to save the amount that you really, of course, would like to be able to save at first, because you're just paying for your expenses and necessities at first. So it will get easier as you progress in your career. And it's really just never too late to start focusing on your net worth into savings. So as soon as possible is best. So this is a good illustration of someone's net worth growing over time and really tracking it. And this goes back to that first equation we had talked about. So as you start increasing your assets and start decreasing your liabilities, your net worth will grow up. And so these first couple of years, so that's when you're in college, you might have a part-time job, but really all that covers is your bills. You can't save much. You can't, it's covering your just very basic expenses. The next little point there is, so you start your full-time job. You'll be able to start saving money. You'll be able to start maybe acquiring different assets. So you can start saving and buy a car, and then you'll be able to start saving and maybe buy a house and start paying down your student loans. And this arrow at the bottom there, so that indicates when your student loan, or you can pay your student loans off. And that you can see it goes down. But once you have those paid off, you don't have to pay that anymore every month, and you'll be able to start saving what you are paying towards that. And as you can see, it spikes and starts going up a lot quicker. This other arrow, maybe you buy a house, so you'll put that down payment on the house and get your house all set up. And then it will, again, once you have that down, it'll start going up again more quickly, and it will rapidly progress as you grow in your career. So Reema is going to talk about understanding your goals next.
Is anyone able to see the slides? I just got a few chats that people can't see. Okay. Joe, do you mind jumping in with the couple of chats that can't see?
Yeah, I'm going to submit my email address and ask people to email me. But what I would also suggest in the meantime is try leaving the meeting and then coming back in. Sorry for the technical difficulties. Try that and see if that helps.
Okay, we'll give that a minute.
Okay.
Jump off and jump back in.
Okay, so we're gonna talk about understanding your goals and budgeting. But there was no information. Okay, so maybe we just had one slide with
That's odd.
issues. Okay. Let me know if there's any other slides you guys can't see. So hopefully everyone can see this one because this is a nice little breakdown of how you could structure. If you're starting off for the first time with how you want to grow your net worth, this is a nice little structure to follow when you don't really know where to start. I like to look at step 0 and step 1 in the very beginning. Step 0, we're talking about just kind of stepping back a little bit and look at the big picture. You need to have, you should try to think about doing a budget and setting some goals. This is gonna be important because you can see for yourself that the actual data in front of you when you set a budget. You can see what the numbers are, where you're spending, how much you're saving, what your income you have available. And it really goes a long way when you have the information to more effectively set your goals and figure out what your needs are and how you can create a strategy to meet them. Once you have that information, as your little backbone, the number one most important step is to build an emergency fund. And there's a study or a survey, I think last year or something, before the pandemic. I'm sure it's different now, but 41% of Americans could not cover even $1,000 emergency expense with their savings. And that's scary because a lot of times these, unexpected costs can very easily drive up into $1,000, couple $1,000 if it's, like a damage on your roof or you have some medical costs. So it is crucial to focus on getting your emergency fund together before you start thinking about some of these other steps. And then once you have that, you can kind of intermingle steps 2 to 6 throughout, based on what your needs are and what needs the most focus at that point in time. I like to prioritize step 2 because if your employer is providing matching funds, this means you make a contribution to your retirement plan, like a 401k, and your employer will put a certain percentage in for you into your account. That's free money. So you might as well take advantage of that and get as much as you can to maximize that. So I like to put that a little bit priority and then work on increasing your retirement contributions elsewhere or saving for other expenses or vacations or paying down your debt.
Yeah. Jordan had a question. Do you have any tips and tricks, suggestions on saving for your emergency fund?
So I'm assuming as far as like strategy, you mean. So if you're looking at, I like to go back to goal setting, which you talked about in a little bit, like set a goal that is attainable for you. So maybe you want to do, start off with like save $10 or $100 or whatever you think you can actually achieve and set it for a time period and, make that happen. Another easy way to do it is to make it automatic. So when I first started off with my job, I was living at home. So I was very lucky because I didn't have a lot of housing expenses. So I set up my paycheck to go, most of it went into a savings account and then put a little portion in my checking. So I didn't even see the money that went to my savings because I wasn't using, actively monitoring my savings account. I was using my checking account for monthly expenses. And before I even knew it, like a year or 2 years down the line, I had so much saved up because I just wasn't thinking about it as money I had available to spend. Of course it is, but I put it aside for future savings accounts and then used that, to set up my emergency fund and then distribute it out based on other things that I wanted to do, like IRA or investing. But that's one way to do it. You could also, there's ways, most banks let you set up automatic transfers into your savings if you want to do it that way. My personal preference is to try to put it into your savings out of your sight as early as possible, so that what I found is when I had excess in my checking, I'm less likely to transfer it into savings, but I'm more likely to think twice about moving money from my savings into my checking when I need it. So that's my suggestion. Abbie, do you have thoughts on this?
I'm going to talk a little bit more on the emergency fund later, just really how much you should try to save for this. And again, I mean, an emergency fund should not be kept in an investment account because, I mean, with market volatility, if you keep that in stocks, I mean, the stock market really could crash. And then when you need that money, it might not be there anymore. So that should always be kept in a checking, savings, or money market account, something that's like highly liquid. So it will always be there if you need it for an emergency.
So as far as budgeting, cash management plan, what I like to focus on when we talk about, we mentioned budgeting a little bit, it can help you get a financial picture, but I also like to suggest that you do a little bit of introspection about yourself. So what are your specific goals? You want to set goals that are going to fit what your needs are and what you like doing. If you want to have a nice vacation, you want to budget for that. If you don't really care, you can use that for some other hobbies or pleasure, spending, things like that. And also, what are your habits, your relationship with how you like to spend and how you like to save? What motivates you to do that? These are very crucial things. If you understand this stuff about yourself, you can set yourself up for success when you do your goal setting and coming up with strategies to meet them successfully. So I like to think about when I started dating my boyfriend, and when we got to the point where we started talking about like money, we have not very different, but we do approach it differently. So I grew up in an environment where money was scarce. I'm a lot more conservative with how I spend it, and he didn't have the same situation. And so sometimes, even though we both have similar values as to our financial future, there are moments where we butt heads sometimes about how we want to spend something or what we want to spend it on. And it just takes a moment for us to step back and remember where each of us came from to understand our perspectives. And I like to mention this because it's just goes so far for you to know how to set yourself up for success with your money, but also how to be able to be in a relationship with someone who views it differently than you. And I think Abbie, who works a lot with divorced clients, probably has firsthand experience on how often a lack of awareness about this can cause problems in your relationship.
Yes. And it is so important to even, I mean, as a young couple, really just to be able to talk about money and for you just to be aware of what your financial situation is and to just talk about it in a very neutral way, not an attacking way, but just go towards it like as you're in a team, because you are. And we actually, Jordan and I, my colleague, we are going to start offering premarital or just people that are young couples that are starting to get married, just consults to help set them up for financial success going forward. Just so hopefully we don't ever have to see them again with the divorce side and just have that not have to be an issue within their marriage.
Yeah, it can go a long way. It's surprising
Yes.
how few people sometimes have these conversations. So when you are preparing your budget, start off with looking at your paycheck. Remember that your gross salary is not everything that you have available to spend. So it can be kind of a shock the first time you realize this, but take a look at your paycheck, add in your gross salary, and then add in all the deductions that come out of it. So you've got your taxes. It's not just federal and state, it's also Social Security and Medicare. So if you look at this example, to illustrate this, $75,000 gross salary for a single person in DC, after taxes, their net take-home pay is $52,000. But that's not really what their take-home pay is, because you didn't account for health insurance deductions, retirement contributions, and then anything else that might be coming out of your paycheck. So start there to get an accurate picture of what you have available for that month. And then go on and add in your whatever your fixed expenses are, and then what your fun expenses are, and use that to help you figure out where to budget and how to cut costs where you need to. Interesting fact about savings rates. So for before 2020, the average savings rate for a 30-year-old was about 7 to 8% for like 20 years. Last year in April, it went up to 33% because nobody could spend it on anything. And so that's very shocking that what it tells you is that if you had to really force yourself, if you were really in a bind, you could find ways to do this. For some people, of course, it's not going to work for everyone, but you could probably find ways where you're maybe overspending in an area where you could be putting that towards paying yourself first and building your financial future towards like your retirement contributions instead, things like that. In 2021, it's already begun to decline down to like 9 to 10%. So we're getting closer back to where it was before now that people are starting to spend money again. So the point is not to cut yourself off from all of your joys and pleasures in life. It's to be realistic with yourself about where you're spending it, so you can find ways to cut it to meet all of your goals, and make sure that you are setting yourself up, your future self, for success, and your current self. Another thing I think is really worth mentioning and like highlighting is live within your means. So if you are going to go into debt to buy something, make sure that you have a plan in place to pay it off. And if you don't, reconsider about making that purchase, because that's going to be a quick way to decrease your net worth, and you can end up in spiraling debt very quickly. So spend within your means, be wise about how you're spending it. We have some benchmarks if you're doing your budgeting, if you want to look at, if you're looking at big expenses like your housing, if your rent is more than 30% of your take home, might be a little too high. Car, we look at around 15%, groceries, $300 per person. I found an example about groceries. So we have this fancy supermarket near my neighborhood, which I love going to because everything looks so great there, so expensive. And then lately we came across this like corner farm market type stand, and it is, I'm not even kidding, probably like 50% of the price of what we were paying at the other supermarket. And the produce sometimes it looks a little funky, but it's still fresh. And so, there's ways you can find ways to, if you're struggling with groceries, there's probably a way you can find cheaper, probably even good quality produce elsewhere. And the SMART goal setting. Some of you may have already heard about SMART goals elsewhere. It works just as well for your financial plan. They should be very specific. They should be measurable. You should be held accountable, realistic, and time bound. So an example of this could be, you want to, let's say your goal is to increase contributions to your retirement plan over the next year. So that's great. That's a great goal, but it's not really useful because you can't measure it and you don't have a way of keeping track of that. You could just put in $1 on December 31st, additional dollar into your plan, and consider that a win. But that's not really doing anything for you if it's just $1. So think about what you can do. Maybe it's $10 per paycheck for the next 12 months. So this now has specific bounds. You have a time frame. It's probably achievable. You could probably find, 3 days of coffee you don't buy out or something to make up that $10 increase if you have to, or maybe it's $100 a month, whatever it works for you. Whoops. My hands are flying. So that would be a SMART goal, right? And that's something you can make automatic too, because once you just submit it on your 401k online portal or with your HR, and it comes out of your paycheck, and you don't even have to think about it. It just happens naturally. And then you look back at the end of the year and your retirement plan has grown. So just be a little bit intentional and specific about how you want to go about doing that. All right, Abby's going to talk about saving and investing.
Yes. So this is another fun illustration. So if you guys want to type into the chat box, so we'll do first the coffee. So if you go, I don't know, say Starbucks or Dunkin' Donuts, you go get coffee every morning. How much do you think that would be worth over, for instance, if you did that for 30 years, but instead of buying that coffee every morning, you would have just invested that $4 every day. How much would you think that would be worth over 30 years in an investment account or brokerage account? $25K, $10K. This one I think will surprise some people. So actually it's over $100,000. Which is crazy. And that's at a 6% annual return. So it's, I mean, I'll talk about this after we talk about the restaurants. It's not to say not to do that, but it's just to say evaluate your expenses and what your different priorities are and maybe cut back in different areas. Just so, because I mean, that, as you see, that adds up and that adds up real quick. And for restaurants, what do you think, the same scenario, but if you were to spend $20 going out to eat every day, how much do you think that would be after 30 years at a 6% annual rate of return? $400K, $800K. Okay, so this one is actually a little under $600,000. Again, that's a lot. But I just with this example again, and it just highlights how much little things really can add up to be. But this isn't saying don't ever go get coffee, never go out to eat. It's just, again, prioritizing on what I guess Marie Kondo says sparks joy within you, and do that. So, for example, I mean, my mom absolutely loves Starbucks. Before COVID, she would go, I'm not joking, 3 times a day. I don't even want to know how much money she's spending there, but it's like she would invite the workers over for dinner or the baristas over for dinner. She's like text with them. It's just her thing. And that's what she chose to spend her money on. And it's like, that made her so happy. So she just does that. But then again, she had cuts back in other areas. Like she doesn't go shopping for new clothes very often. So it's like she has that free money to be able to do that because she just loves doing that so much.
Hopefully they're also giving her free coffee every now and then for being such a loyal customer.
Yes, she has the gold card, and it's like however many things she spends, she gets free stuff. And it's like every time I go to Starbucks with her now, it's like, oh yeah, we have 10 free drinks on here. I'm like, thank you. Don't have to pay for that. But it's just something to think about. So where are you spending your money and what makes you happy? And if you're able to afford that, then you should spend it on that. So savings, here is where we want to talk about emergency funds again. So just rule of thumb, emergency funds should be enough to cover 3 to 6 months of your expenses not your excess, just entertainment expenses, but your fixed expenses. And you need to be able to keep that somewhere, again, in a liquid place, meaning easily accessible, will be there. Saw the mutual fund question in our chat box. Since mutual funds tend to mimic the market or a market, again, if the market takes a big downswing, so will that mutual fund. Mutual funds aren't as risky as stocks, but again, there is that chance that if you need, say, for instance, a burst pipe in your basement floods and you need repairs, and that ends up being $10,000. If you don't have that somewhere liquid and the stock market crashed, I don't know, a month before, that money just won't be there, and you're going to be like, oh, what do I do now? Because that money is, not available for you. So preferably do your research on different high yield savings accounts. There are different accounts available. Again, on bankrate.com has a good list of the current ones, and they'll have high yield. So if you spend, I don't know, the one that I have, it's like if you have 10 transactions on your debit card that month and you have X amount, you'll get a certain percent interest payment every month. Also look up for accounts that have sign-up bonuses, no maintenance fees, etc. Just because that's free money. And then once you build your emergency fund, you can start building for specific reasons, so on and so forth. And you're going to, well, this isn't in any particular order after your emergency fund, but you should first really try to maximize your 401k, 403b contributions if your employer offers a match, because that match is free money. So as much as if you can contribute the amount that you need to be able to get that match, I would highly recommend doing so. And then once you do that, you could start contributing to a brokerage account, an IRA account, depending on your income. It would either be traditional or Roth. Roth is there are different thresholds for Roths income-wise. So that would maybe be a smart idea, because that income now grows because you put your, not to get into I can't speak, sorry, specifics of IRAs and whatnot, but that would be money that's already been taxed. So once you go to pull it out at retirement, then that would be a tax savings opportunity. But you can only do that if you're under a certain salary. And then you would start saving, as Reema spoke on, for different goals that you have. So say vacations, saving for a down payment on a house, saving for a new car, saving for an engagement ring for your girlfriend, something like that. Just different goals, and just base needs. Have your emergency fund, and then you can start doing other things. So these are different investment options that there are. Mutual funds are actually, they're very similar to exchange traded funds, but mutual funds tend to be a little bit more expensive because they're actively managed. They're index funds, and they mimic the market. So do ETFs, and they trade just like stocks, but ETFs aren't actively managed, so they do tend to be a bit cheaper. Stocks are risky. If you're not gonna actively manage those and do your research on the company and just how the market is and keep an eye on that, yes, it can be a big payoff, but again, it can be a big loss at the same time if you're not going to be actively managing that or doing your research. A good example I like to give with stocks, or think about the whole GameStop Dogecoin phenomenon, how that went up super quickly earlier this year and then just tanked. Other investment options are private equities, real estate, physical assets. Again, physical assets, not to keep going back to the Kardashian examples. That is one of my favorite trash TV shows. Love it. But Birkin bags, that's a physical asset that if you keep in great condition it doesn't really lose value, because there aren't very many of them, but not your average Joe can afford that. And so on, just different fun things like that. So key ideas, really discipline and time. Reema touched on this a bit earlier. A very simple automatic investment plan doesn't have to be made up of a lot of funds. So just a mid cap, small cap, large cap funds kind of covers your general sectors of the market and the different company sizes and what. And that would give you a good diversification within the market. Index and target date funds. So index funds mirror companies and really the performance of the market index. Like, for instance, it would mimic the S&P 500. Target date funds automatically rebalance based on your time horizon, and they slowly decrease as you approach retirement. But if you invest in other things, that can throw off your diversification. So just be aware of that if you do choose to do that. Individual stocks, as I said, those are super risky. If you actively manage them and put the time and effort to learn how to do this, it can be a great payoff. But if you're passively managing them, again, it can be a big loss. So it's your risk profile and what you're comfortable with doing. I personally, in stocks, I don't like to put more money than I am okay to lose. into those funds at this point in my life, just because it's like, for instance, cryptocurrency. You can just play around with that, but I'm not going to invest, I don't know, say, for instance, that I just bought a house, I wouldn't invest the down payment on my house in cryptocurrency, because if I needed it at closing, I mean, I'm glad I didn't do that because it wouldn't have been there anymore at that point. So big thing, pay yourself first, as Reema touched on. If you just have an automatic transfer to a savings or a brokerage account, you won't even be tempted to spend that money. So just make sure that's coming out first. So you make sure you're at least saving something. Rule of 72 is pretty interesting. That tells you exactly how long it will take to double your investment. So you take 72 and divide that by the annual rate of return on an investment, and that what the product is there is how many years it would take to double that investment. And as also Reema touched on earlier, since I do a lot of divorce financial planning work, a lot of times I see one half of that couple has no idea really what's going on with the financial situation. And through that process, we kind of try to bring them up to speed with it, educate them. And just, if you have a grasp and take the time to learn what your finances are, like, I don't want, I'm not meaning go be Warren Buffett, but just understand your own personal finances. That is so invaluable to you and your life and going forward and being able to set yourself up for financial success. And just be aware of what's going on, what you're spending, and just take the time to learn it, because it will be invaluable to you in your life. So a couple common myths. So only experts can invest and perform well. That's false. The market is too risky. Some stocks are risky, but overall, there are investment options that don't carry too much of a risk. It depends on you personally on how much risk you're willing to take. Investing is only for the rich. You can invest, I think, what is it called? Acorn. There's an investment app where it legitimately invests pennies, rounding up to your next dollar on your spending. So it's not just for the rich, and it's never too early to begin. It's pretty easy to start investing. Just do some research based on your risk profile, and you can just put some money in there and just start little. And then you can watch it grow over time, and it's going to be doing more for you in the stock market than it is going to be sitting in a savings account.
And with mutual funds and ETFs, like, a lot of the stuff is, like, you're holding most of the time, especially at this stage in life, you're going to put something in a mutual fund. It's going to be there for decades. And by the time you take it out, it's just going to grow. And they're, most of the time I think nowadays, like, the ETFs are zero cost, no commissions, which makes it more accessible to even more people than ever before. It used to be that, if you trade stock, you have to pay a fee or commission or something like that. So it's not, like you said, it's not just for the rich. It's even more accessible to the average person now than ever before, I think.
It is. And timing the market, people say they can time the market and become super rich off of this, but this is very, very difficult to do. And there are so many different factors in the market that timing the market isn't always the smartest thing to do. And investing in individual stocks, I've touched on this a couple times. Do your research and invest the time on learning how to do this, and be prepared to actually actively monitor that, just so you don't end up losing a bunch of money, because it takes a lot of kind of knowledge to be able to successfully do that. Keep in mind, you should know your short, medium, and long-term needs. So the time frames for these different things are different for everyone. It changes from person to person. So think short-term vacations, medium-term, that could be a house, that could be a car, and long-term retirement. And those could, really, house could be short-term, car could be short-term, but it depends on where you are and your specific situation. Liquidity versus risk is inverse. The more liquid an investment it is, the less risk it has. The less liquid an investment has, the more risk it has. For instance, a savings account you can access that money at any time. Bitcoin, that's extremely risky. It's a personal preference, but you should have some of each. And then cash, again, cash is king for emergencies. You want something that's always going to be easily accessible when you need it in some sort of emergency. Fees, there are advisor commissions, transaction-based fees within really any brokerage sort of account. You should do your research on this. There are fee-only versus fee-based advisors. There's really no sort of free advice. That's always going to come with some sort of fee.
But if you are going to seek out an advisor, I would recommend you go for fee only. That means that they are not paid a commission to recommend products to you.
Yes.
A lot of times, it used to be that a lot of them had relationships with different, insurance or whatever, and they would get a commission off of recommending a product to you, which then no longer makes it in your best interest necessarily. You don't really know. So just look out for that. And now I think they all have to disclose that information. And if you don't see it disclosed, you should ask.
Yes.
So we talked about, speaking of the liquidity risk inverse relationship, let's say I like looking at this down payment example. If we look at, you want to get a house for $400,000, you need $40,000 if you're going to put 10% down. Assume a 5-year horizon. It's tempting when you look at this bar graph here. Blue is cash, orange is equities. And in years 1 through 4, naturally market tends to perform better than cash. Cash, we're earning around 1% here. Equities, we're assuming about 5% return. So just by looking at the first 4 years, you might be tempted to think, okay, and we kind of got this question earlier too, should we just put this money in a mutual fund or, invest in the market because it's just going to grow faster. But the problem with doing that is that you don't know what's going to happen with the market when you go to take that money out. So if you have a high cash need, like a down payment, keep it somewhere safe, because in our example here, we're assuming, what happens when you have a 40% loss on closing. So in year 5, you see how that just dropped down, and now you have to make up another $10,000 or $15,000 at the very end in order to close on your house. And how I don't know, most people are not going to be able to scramble around for that much money at the last minute after you've just spent 5 years saving for such a significant sum. So don't gamble with high cash needs. Don't fall into this trap. We talked a lot about assets and increasing investments and retirement and things like that. We're also going to spend a little bit of time talking about managing your debt and strategies for decreasing your liabilities, which, remember, is another way to grow your net worth, is by decreasing liabilities. What the main takeaway from here should be, as we go through these next few slides, is that not all debt is bad debt. It's not necessarily the right move to just aggressively attack all of your debt until you have none left. Some debt is helpful, especially when it helps to finance an asset for you, because that asset then increases your net worth. So the goal is not to just eliminate all of your debt, and especially ones that have low interest rates. They can help you finance those assets. Other debts, and the key is with your strategy, is to identify which ones are not doing anything for you. So other debts don't really lead to an investment in your financial future, and most of that is consumer debt. They only increase your liabilities, and most of the time they don't really have a corresponding increase in your assets, maybe a little bit depending on what it is you're buying. But if it's not a house, it generally isn't something that's going to increase your assets significantly to the point where your net worth grows. And credit card debt can often result in higher interest rates and fees if you're not paying it timely, if you're unable to pay timely, and all of these things cut into your net worth.
So student loans, really, you should take the time to fully understand what the terms of your loan are. So interest rates, what the monthly payment is, how long you have to pay them off, just different things. So there are different base or repayment things. So you could defer your student loans till, I guess, finish school, so on and so forth. There's income-based repayment. whatnot. So a good option, I mean, right now, especially, is because interest rates are so low, should look into consolidating, refinancing them now, because rates are between 2.5% and 7% for fixed and variable rates. And I mean, if there is an option, if your family or any of your relatives are able to kind of help you out with that, and maybe you take a loan from them and the interest won't be as high, that's an option. And then you could pay them back over time. And there are forbearance, loan reliefs, just different options in that arena. I know with COVID, they just extended the federal student loan repayment. So I believe it's January of 2022. So with that, I mean, hopefully the president will end up pursuing the student loan forgiveness. I was very excited about that when they were talking about that. So I'm hoping that's a follow through. And then again, we get this question a lot, should you pay more than the minimum? So this really depends on what your interest rate is. If it's a very high interest rate loan, you should either one, refinance that, or try to pay that one off more quickly than the lower interest rate ones. Or if it's a lower interest rate loan, alternatively, you may end up being able to make more money if you in turn invest that extra money you could be paying towards your loan in the stock market, because the stock market could be outperforming what that interest rate would be. So for instance, if the market is having a good year and you're getting a 10% return on all your investments and your student loan interest rate is only 2.5%, if you just took that money and invested it, will actually have more money to be able to then maybe eventually turn around and pay off that loan than just the little bit of interest that's accumulating on that loan. So that's just one comparison to look at. Let's see. Next, Reema was going to talk about a bit about consumer debt and credit cards.
So let's say you do have consumer debt. We talked about how you want to try to avoid this if you can, but if you are stuck with consumer debt and you're not sure how to go about paying it off or what the plan should be here, make a plan. You can do something like try calling different, the companies. They might be willing to reduce or discount or adjust your balance. And I have heard of this mentioned in one of the podcasts I really like, How to Money, which is in our resources slide. They talked about how oftentimes they had significant success with just making a phone call, being nice to the customer service, and they were more than willing to work with you. So that's always an option. Give it a try. You can look into consolidating. And then as far as, then make a plan about how you're going to pay it off. And this is where I mentioned earlier, knowing your habits and what motivates you comes into play here. If, you can start either with your smallest debt first and pay that off. And that'll be quicker to get to the first balance, but it'll, you get that quick wins earlier. But if you go with the other extreme where you start with your highest interest rate or highest balance first, it's going to take a little bit longer to get to that first barrier. However, you're going to pay less interest and it'll be faster once you beat that first hurdle. But if it's going to demotivate you because it's taking so long to clear the first balance, then you can consider starting off with a smaller balance first. So just know what works for you. Always pay the minimum balances for all of them, regardless of which balance you're tackling first. Still pay the minimum on everything else, because that's how you expose yourself to the interest rates and fees. So the important part about making sure you pay off your balances and not taking on more debt than what your limit allows or what you're capable of paying back is that it impacts your credit score. And having a good score helps you in the future when you try to take on higher loans for your car or your house, and you can get a lower rate of interest if you have a good score. I also strongly recommend that you all request your credit report. This is not the same as your FICO score that you get on your bank apps. That gives you a good, just summary. But I find a lot of people don't really know about the credit reports that you can get and how to get them. We do link up to that in our resources page. There are 3 companies that are required to give you one free report every 12 months. So I recommend you doing this, especially if you've had issues with, identity theft. this is a good way to catch any weird activity that's going on with your credit usage. And it also gives you a picture of what accounts you have open, and it gives a lot of detail. So it may not make sense at first, but I recommend you look at it so you get familiar with what's out there in your name. And then if you are looking to open up a new credit card, I really like the Points Guy. They constantly evaluate the different credit card offerings, the perks that are offered, what kind of benefits you can get. If you want travel points, there are cards that are better for that. If you want other types of awards, there are cards that are better for that. There are also several that have annual fees. If it's your first time getting a credit card, I discourage the annual fee unless it's going to be really worth it. It can be worth it, but I think, first just get a basic credit card so you can build up your credit by making, even if it's just small purchases, buy like a $5 coffee or whatever and pay that off. And that'll help you increase your credit score just by showing that you're using less than your credit line, you're paying it off timely, you're paying it off in full.
Your question about credit cards and if you recommend paying the minimum or larger credit card balances. So we do recommend you pay it off in full if you are able to every month, just because if you do that, you're not going to have any sort of interest on that balance. If you don't, you're going to end up, and with credit cards, the interest rates typically are very high. So if you are able to, pay the full amount, and if you're not able to, pay more towards the credit cards you have with balances on them that have the higher interest rates.
Yes, agreed on that. Okay, this is everyone's favorite topic. Let's see if we can go through this quickly with the time we have left.
Yes. Okay, I could talk about this one for a while. Again, I just bought a house, so good kind of person to talk about both of these things. And I've had some hiccups since moving in 2 weeks ago. Big hiccups, but oh well. So renting is good for if you are planning on being there for short term. So that's really 6 to 24 months. The benefit with renting, you have pretty much no maintenance expenses. It's very easy to move around. So for instance, if you're just changing jobs, you aren't sure if this is what you want to do or where you want to be for more than 5 years, I would definitely recommend renting. The downside about renting is, again, you're not building equity with your rent payments, and rent can increase every year. But again, with limited maintenance expenses and the flexibility you have with renting, it's great. Typically people are like, buy as soon as you can, yada, yada, yada. But if that's not where you want to be and it's not really fitting for your situation, renting is a great option. Owning or buying a house is good if you know you want to be in the area for a longer period of time, say 5 to 7+ years. This is a form of an investment. And your mortgage payments are more fixed, and they might, if you have your taxes and insurance coupled in with your mortgage payment, it could increase a little bit because of the taxes and insurance each year, but your principal and interest payments, that lump of principal and interest is going to be the same going forward. Buying you will have significant maintenance expenses. I had a little fluke with this one. I moved in, and 6 days after I moved into the house we just bought, apparently the sewage pipe in the front yard had tree roots all mangled in that. And that was a fun, about $8,000 expense you do not want to have when you first move into your house. So again, be prepared for that. And hopefully there's no big things like that, but that is something you need to be aware of. It's more than just your mortgage payment. And so your move-in payments, your just maintenance payments, it's something that you need to also have. I mean, I'm glad I had an emergency fund for that, because that is, again, something you need to budget for, is when you own a house are the upkeep and maintenance expenses that will inevitably come up. So now, right now, again, is a interesting time to buy. I know this spring the market was pretty crazy with the amount of competition, but again, the interest rates are super low, and you can lock in that rate now if you do go to buy. Houses might be a bit more expensive than they were a year ago, but again, with that interest rate, it's pretty good. And just make sure you fully understand what your cash flow is when you do buy. I mean, every 100,000 financed in your mortgage, it's about $400 a month at 3%, 4% at 470 or 475 a month. And really, rates are important, but being able to afford that house is more so. And just don't wait for that perfect deal to come up. And you do not have to have 20% down to buy a house. I mean, I didn't put anywhere near that down. And I mean, my mortgage payment is the same as what my rent payment was for a 1-bedroom apartment to a townhouse. So it's like, keep in mind those considerations. It's like, I want to be in this area, so it's a good time to buy. And then again, just keep in the back of the mind the expenses that do come in with buying: moving expenses, furniture, just maintenance expenses. I mean, it adds up, but again, you are building equity within that house, and more often than not, if you stay there for a bit of time, you will end up getting money, a decent amount of money back from buying that house when you go to sell it. Reema, did you want to go through some tips?
Yeah, so we'll go through this really quickly. I think we kind of covered a lot of this already. Always pay on time, even if it's a partial payment. Wherever you can pay the full balance, pay the full balance. That's the recommended approach. If you can't pay the full balance, try to pay the minimum. If you can't pay the minimum, pay it whatever, as much as you can. Just try to keep that debt payment controlled. It's okay to have some debt, especially if the rates are low, where you can, utilize the excess cash. Instead of paying off the debt, you can invest it in the market to earn a higher rate of return. And then, look into other options for personal loans and refinancing and things like that. We are getting close to the hour, so we'll keep going. If you guys have to drop off. This being recorded, this link will be available, so you can finish watching the rest of the presentation. We do have some good stuff towards the end as well, but just letting you know, if you have to go ahead, feel free to do so. And email us with any questions that you have. So your biggest assets are you and your family. So you want to look into making sure that they're protected as well. And what I'm going to cover here really quickly with insurance. Insurance is generally a needs-based approach. I'll talk about life insurance very briefly. This can get very, very complex. I can't go into enough detail here, and it's all very situational. So there's no, one piece of guidance for everyone. But what I've seen, some traps are, especially, this happened to my brother. He had a friend who was working at a company that was going to earn a lot of commission and told him that he needed to get life insurance. Otherwise, his parents would be responsible for his debt. His parents are not dependent on him for his income. And so he really didn't need to get life insurance, but he got stuck with one. And it's really hard to get out of it sometimes. You have to pay more even to get out. And so, and his friend made a lot of commission on this. And so this happens. It's not the first time I've heard the story like this. It can happen like that. But what you do need to think about is, the opposite extreme is if you do have someone that is dependent on you for your income and something were to happen where that income is no longer there, untimely death, you do need to consider life insurance. Premiums are cheaper when you're younger. They're more expensive as you get older. This makes sense. It's, risk-based, but that doesn't mean you should get it right away, especially if there is no one relying on you for the income. Just a basic sort of delineation, I guess. Term life insurance covers for a certain period of time, specified period of time. Whole life is permanent coverage. It covers for the whole life. So keep that in mind. There's different, situations where one is more, useful than the other. And within each category, there's also several different options. So whether you're looking for investment options also, fixed premiums, risk tolerance, things like that. So reach out to us if you need any guidance on this. We're happy to help out, but we won't be able to go into enough discussion on this here because it can get very confusing. health insurance, most employers provide this. If you have the opportunity to get a high deductible health plan, you can open up a health savings account. And this is one of my favorite things ever. And I think it's Jordan's favorite thing too. I remember from when he talks about it. But it's like you get a deduction when you make a contribution into the plan. The money grows tax-free. And then you don't pay tax when you take money out of the plan for qualified medical expenses. So that's just one of the only situations where you can, double dip basically. You don't pay tax when you put it in, you don't pay tax when you take it out. And then once you hit retirement age, it acts like an IRA account. So yes, you can take it out to use towards non-qualified medical expenses, but you do pay tax on it. But again, if you don't end up having those high medical expenses and you have this money sitting in the HSA, it's basically just like another retirement account. But trend generally is most people have really significant medical costs as they age. So I don't think that's going to be, you're going to end up with all this excess cash with nothing to use it on. The most underappreciated aspect of the slide, I think, is the disability insurance. Most people don't think they need this or don't really give it the proper respect or attention, but this is to cover what happens if you are no longer able to perform the duties of your job. And that can result in significant loss of income or all of the loss of income. And I think it's very highly underestimated, but it can be pretty cheap to get coverage for this. And you don't always know if you're going to get a disability, if you're going to get injured and be disabled, or if you're how long it's going to last for. So, I think this is something very crucial for everyone to consider looking at as part of their plan. Another thing to note about short-term disability is that there's a waiting period. So make sure it doesn't start on the day one of injury. Make sure that you have enough funds to cover that portion. I think I forget what it is. I think it's between 30 to 90 days on average. So make sure you have enough funds to cover that gap until, the payments kick in. And most of the time, long-term disability is offered by employers, and there might be a short-term disability offered as well. And I think I covered the main points here. Estate planning, another topic I know people don't like to think about in their 20s and 30s. It seems to be a thing that you only really think about later in life, but it is very important at any age, at any stage of life. So what happens if you don't have this in your plan? If something happens to you and there isn't a will in place, or you don't have designated beneficiaries on your accounts, your assets are going to be decided by somebody else on where they're going to go. And it can take a long time for it to go, get distributed out. It may not go to who you wanted it to go to. And so people are relying on you for that inheritance. Just keep that in mind. It could be a while before any of them see that. It may not even go to them if you don't have this designated out. If you are in a situation where you can no longer make medical, decisions for yourself, do you have somebody assigned that you trust to make those decisions for you, those medical decisions? That's where an advanced healthcare directive comes in. And then, power of attorney also designates someone else to be responsible for certain decisions as well. So I just really recommend think about this. Make sure you have some kind of a plan. It doesn't have to be complex and costly or anything, but these are the things you should think about when it comes to estate planning. And there's just different ways to protect your family. All right, real quick, tax planning. So make sure you file your taxes on time. They're due in April. Forget about the 2020, 2021 deadlines. Those are just
hiccups.
Yeah, they're just hiccups. That doesn't ever happen. But so file by April 15th. You can get an extension until October 15th. That's to file only. It does not extend the time to pay. So if you owe tax on your return and you haven't paid it by April 15th, you'll be assessed with penalties and interest. And a lot of people are surprised by that. Stimulus credit, this is going to be similar to last year. When you go to file your return, your credit will be reduced by payments you received already. When is a good time to review your withholdings? I think a good time would be to, when you file your return, if you have either a huge balance due or a huge refund, go back and look at your withholdings and adjust them accordingly. The goal is not to have a huge refund when you file your tax returns. That's basically, you've loaned free money to the government with almost no interest rate, basically for a whole year. So you could have used that money to build your emergency fund, pay off your debt, invest, increase your investment portfolio, increase your retirement, and instead it was just, loaned off for free, basically. So the goal is not to get a huge refund. The goal is to just get, just zero, obviously would be ideal, but a little bit, get a small refund, whatever, but enough that you're not having to pay any penalties and interest, and enough so that that money is not being, inaccessible to you until you get the refund. Some interesting topics here that don't get, I think a lot of people probably don't know a lot about. Savers credit, you get a percentage of your contributions towards your retirement fund, which is great. So if you meet the criteria, you're over 18, you're not dependent, you're not a full-time student, and your AGI is within 33 to 66,000, depends on your filing status, look into this credit. HSA contribution we talked about, amazing if available to you. I strongly recommend that. Roth and traditional IRAs, there's different opportunities here depending on your situation and your income levels and your age and things like that. Roth is post-tax when you contribute, and traditional is pre-tax when you contribute, and then the opposite when you go to take it out. Student loan, if you have student loan debt, there's interest deductions available if you're not phased out. Oh, and also look at if you're a resident in Maryland, look into the student loan debt relief tax credit, which I don't think is common in a lot of states. So if you are a resident in Maryland, look into that. You get a credit for having debt, basically, if you have debt. And then mortgage certificate program, this is another dollar for dollar credit based on the percentage of mortgage interest paid each year. Okay, almost there.
Yes, this is the last section we're going to be talking about is job offers, job planning, basically how to compare just different offers, whatnot, and basically the values of each company, because it's not always just the base salary. There's a lot of other things that kind of go into your personal, like, work-life preference, happiness within a career. So what I like, the personal factors. So is there going to be a work-life balance? Are you going to have to travel? Are you going to be able to work from home? What benefits do they offer? Do they offer like any sort of retirement plan match, insurance, vacations? What different perks do they have? I mean, are they near you? Are you going to have to be sitting in your car for 3 hours every day trying to get to work? And really what you do is you'll have access to this chart once Joe puts it up or sends it out after this presentation. So just go through here if you are looking for a new job, go through, rate what your needs are based on each, and every offer that you get, rank what the employer is offering in each of these columns, and then just see which one matches up best with what your needs are. And that will be fairly clear and easy to see which job would be best for you personally. And then these were just the resources we had touched on throughout. They're all great. Mint, great budgeting app, just kind of tracks all of your spending and basically shows you, oh, I'm spending too much in a category, I can cut down here, whatnot. The Instagram and podcast, different links. Reema and I both like all of these, and they make learning about finance entertaining and are very educational. So these will be on the presentation or on the PowerPoint, and then here are some upcoming seminars if you guys want to register or join of any of these. I believe that is it. So thank you guys for staying on a bit later. Sorry we went over.
And just reach out if you have any other questions.
Mhm.
Or if we didn't cover them during our presentation. We tried to get to the ones that were submitted. We couldn't get to all of them.
This is the last slide. So email us if you have any more questions. And then thank you all for coming.